I think with impact investing in general, there's an intellectual honesty problem, which is welcome back to another episode of The State of Sustainability. This episode, we're going to go a little off-piste from our usual fare. So the last couple of episodes have been very resilience and volatility heavy. And just to keep things a little interesting, keep things a bit spicy, this time we're going to talk about impact investing. So a few caveats before I jump into things. For most of this episode, I'm going to have a big basket of impact investing, which includes ESG investing, sustainable investing, everything that you could imagine being under that category of like mission-oriented investments. In general, I'm going to focus on the mainstream asset class, I would say, which is things like mutual funds, private equity, sustainable bonds, all the stuff that is kind of really available to the market at large. I'm a little less oriented towards things like VC, venture capital, climate tech VC, etc. But I'll weave that in a bit as well. And so let's kick off. I want to kind of go through a journey with you guys that starts off with an assessment of the status quo. What are the facts today? We're then going to move into what have we learned from the facts as they are? And then where do we think this space is headed? And is there a future for impact investing or not? So to start with, impact investing stock is still near its all-time high, but in general, the inflows have collapsed. What I mean by that is the assets under management for impact investing are still super high. They're about $1.5, $1.6 trillion, which is pretty close to as high as it's ever been. At the same time, the amount of money flowing into the space has generally declined. And in the US, for example, has for the last, I think, 10 quarters, consistently looked like outflows rather than inflows, which means that money has actually left the space net rather than moved into the space net. In Europe, the story is a little more mixed. So there have been some quarters in the last few years where there have been outflows, some quarters where there have been inflows, but it is generally speaking an outlier for there to be net outflows in Europe because historically, so more than the last few years ago, Europe was generally always putting money into the space. And so on the whole, what we're seeing is that while the assets under management are a little down, but not a huge amount down, the inflows are generally actually declining in most places and net outflowing. One pocket where it's still growing actually is the Middle East. That's quite interesting. And I think it actually speaks to how we tend to miscategorize impact investing more than it says anything about the Middle East being really gung-ho on mission-oriented investment. By that, I mean, if you look at sukuks or Islamic finance instruments, much of that ends up being classified as impact investing, even though it could actually be going to a wide range of different purposes and is just a way that people raise money in the Middle East. So I think there's a categorization problem there. So that's a little bit about where the money stands. Let's now look at where the returns are. And I often kind of do the Jerry Maguire show me the money catchphrase here. And then I realized the other day that no one has seen Jerry Maguire anymore. And so I phased it out of my lexicon of pop culture references. But anyway, let's go back to returns. So are returns in the impact investing space high, low? How do they compare to the market? So what's interesting here is that most of the assets that sit within ESG funds tend to be, what's the best way to put this? Tend to be a little confused. So if depending on the fund that you look at, you'd find Tesla, you'd find Nvidia, you'd find Microsoft, you'd find quite a wide range of different stuff. And that's because ESG, the term, has originated as a risk framework, which means that many ESG funds basically say, as long as you're not ESG risky, we're going to consider you to be ESG friendly, which means that you can come into our ESG investment fund. So they tend to exclude oil and gas, let's say, and be underweight oil and gas, but generally otherwise track more or less the market. What that means is that their performance ends up being sort of cyclical based on the sectors that they're invested in. So if oil and gas is actually doing well, oil prices are high, oil has made a comeback, then suddenly ESG funds underperform the market. If actually oil and gas is doing poorly and renewable energy maybe is on the rise, then suddenly ESG funds start to look really good. This makes them a fairly unreliable place to invest. And in recent times, most ESG funds don't seem to have done particularly well. But they have had their moments. I would say because of the unreliability of what you're including, it doesn't really seem to me like it matches a thesis that an investor might have. I think what could be a nice way to change this up or make it more ESG relevant is if you start having ESG aligned short funds rather than long funds. So most funds tend to be long funds where they're taking a position in a stock and they're expecting the stock to grow over time. But when you have a risk-oriented approach and you're saying, actually, we think that these companies have miscalculated a certain risk associated with ESG, it would actually make more sense to have a short fund, which means that you're betting on certain companies doing badly rather than betting on other companies doing well. So just to recap where we are in the status quo, assets under management still somewhat high, not as high as they've ever been, but somewhat high. Flows going down, returns kind of all over the place, no clear indication of what the value prop is. Now, let's go a little bit into the history, I guess, of where impact investing came from. Impact investing has sort of evolved, as far as I can tell, along two parallel strains. One is the private market strain, where basically impact investing originated in impact funds that had an impact thesis. I'm going to say a little bit more about that in a moment. And the other is this ESG framework that we touched on. So let's first go to the private market piece, which is more interesting, I think. So on the private market side, let's go back, 20, 25 years. I mean, the first ones that I came across was the Acumen Fund back in, I think I first came across them in 2009 or 10. There's some of the OGs of this space. Bridges Ventures, Sir Ronald Cohen or Ronnie Cohen, again one of the trailblazers alongside Jacqueline Novogratz of the Acumen Fund. Root Capital. A lot of these are the early funds that went into the space with a mission-aligned thesis, and the idea was we are going to find entrepreneurs solving social problems. We believe those social problems are underinvested in, and we're going to dedicate capital to helping those entrepreneurs solve those social problems. And we're typically going to measure our returns in monetary terms, but also in social terms, the double bottom line. Kind of emerged, and you also have the triple bottom line and probably also quadruple and quintuple bottom lines by now. But this was the original idea and original thesis, and they tended not to invest in anything that didn't really meet one of their social themes. Often they also had different sub-themes. So I think Acumen Fund at some point was, I don't know if they still are, they were looking at agriculture and water and housing and different sort of social missions. The places, these were the GPs or the general partners managing the money, and the places where they would draw money would often be maybe money that would have gone towards philanthropic causes, but actually wanted to get a bit of a return or wanted to put money behind capitalism, because many philanthropists actually believe that capitalism can be a more effective vehicle for solving social problems than philanthropy. And so that was a lot of the place that the money came from to these places. These funds many of them are still around, still doing great work, but this was one of the original areas where impact investing sort of grew into the mainstream from. And there's a lot of sort of scar tissue in that space. And what is interesting is I saw I've interviewed Jacqueline Novogratz as well at some point, and kind of have been following a lot of her work in recent years too. And I think she mentioned that the Acumen Fund in all its years has only had one or maybe two unicorns grow out of it. And I think that, that speaks to the way in which Acumen Fund looks at other types of returns, social returns, not just monetary valuation-based returns, but it also tells you a little bit about how even the funds that have been doing this for decades and doing it with a really hard mission focus don't actually deliver the same sorts of monetary returns that a mainstream fund might be expecting with a similar pedigree and a similar duration. There was a negative poster child for this as well, which was Abraj Capital. I don't know if any of our listeners will remember or have heard of Abraj Capital, but this was probably the peak frothiness or the peak heyday of the private market impact investing side. Abraj Capital grew out of Dubai, was an emerging markets asset manager targeting investing in major social themes in emerging markets like healthcare, infrastructure, sanitation, all these sorts of areas. And a lot of the money that Abraj managed came from organizations like the Gates Foundation and Bill Gates' wealth and other similar billionaires who wanted to put money behind impact causes. What worked for Abraj Capital, I think, and what has worked for emerging markets investors targeting a mission focus has been that in many cases in emerging markets, social causes and economic interests go hand in hand, actually. So if you're investing in healthcare in emerging markets, healthcare tends to be underinvested in emerging markets, but there's also a big market for healthcare in emerging markets. There are many paying patients, paying customers who want to access healthcare. And so if you set up a offering at the right price point, you can actually make pretty good returns because it's a mainstream product in a mainstream category in those markets. Same thing with housing. In some areas, some markets, affordable housing is a social good, but also just a good business offering because that's what the market requires. Abraj later collapsed in a heap of scandal because it emerged that the founder and head of Abraj Capital was using funds interchangeably across different purposes. But that's a story for another day, and you can find that in the Wall Street Journal. Let's move into the second category of investments. This was all about the whole private market piece. Let's now go over to the ESG framework that was adopted by public markets. And I think this is where what was boutique and artisanal in private markets was kind of attempted to be taken mainstream and I think hasn't worked out super well. ESG was born as a risk framework. The first uses of the term ESG that I've come across are in the mid-90s in some UN committee. I had to really dig for this. In some UN committee where it was a group of finance professionals trying to think about how to bucket together everything that was non-money related when looking at potential assets to invest in or lend money to. And they thought, well, ESG sounds nice. ESG then sort of grew into a risk frame around 2004 with the UN Global Compact paper, Who Cares Wins. And from there, they sort of basically tried to codify this as a framework for how you would invest and how you would kind of assess societal, environmental and governance-related risks on a target investment or a target company to lend to. World Economic Forum took it from there and they were off to the races with many different articles, many different ways to cut this. Sustainable Development Goals also became one variation of this and so on and so forth. From there, public markets then started to, I would say, get on the bandwagon, and the bandwagon kind of left the station around maybe 2016, 2017 in earnest. That was when I sort of started to clock real money going into this space and said, well, what if we were to have mutual funds set up to invest in ESG as a theme? For those who are not keenly aware of what a mutual fund is, this tends to be where an asset manager will say, let's pool together a bunch of money into a sort of mutual pooling of funds and then invest this bunch of money in a bunch of stocks, typically public stocks that are listed on the stock market or bonds that are being issued by major companies. And so what you might get is like a Vanguard, for instance, that manages most of our pensions for everyone in the world, might have an ESG-oriented fund, and that ESG fund will then go and invest in ESG-compliant investments. As I touched on a little earlier in this episode, I think one of the challenges there is that ESG was originally really an exclusion framework, and it was sort of then positioned as an inclusion framework. So by an exclusion framework, I mean it was a reason not to do something, and it kind of was then interpreted actually as a reason to do something, which is let us put money into this company because it is ESG compliant. And I think that's a slightly flawed way to look at this, and unsurprisingly, has not really led to outsized market returns in the way that was promised. The high point of this was Larry Fink's letter to shareholders, where he basically said climate investing is the new normal of investing. Everyone should be investing in this space. And then since then has exorcised any reference to climate and any action that his fund takes with respect to climate or impact. So really, I think it ended up being quite frothy with much ado about nothing. So what did we learn? A few things, at least this is what I've learned. One is ESG was stupid as an investment strategy. And I think this is because, again, it was a risk lens. And as a risk lens, the thesis is that some firms are mismanaging or mispricing their non-financial risks. If that's true, then the alpha from an investment perspective lives in the gap between the current price and the correct price. This means that if you want to capture the gap, you need to make a short bet. You need to make a bet that the company is actually going to do worse because they have mispriced, rather than have this long bet where you're expecting a counter company to do well. As a result. I think there's a few exceptions to this. I think there's a few little maybe caveats, which is you could say, well, what if I kind of believe that actually one company that I want to invest in is really on top of a particular anomaly or on top of a particular moment in history? So let's take a few examples. I think that a Tesla, let's say, is investing in electric vehicles. I think that long term there's going to be a movement away from oil and gas, and I think that long term electric vehicles are going to be the name of the game, and therefore Tesla will do well. Go back, let's say, about 10 years and you kind of might have this thesis. But I think that the flaw in that argument is that a Tesla is unlikely to succeed purely because it is in the right space thematically. It's more likely to be successful because it is capturing long-term tailwinds, such as this one, but also a well-managed business, creating good IP, extracting good margins from its customers, and so on. These businesses will tend to look just like good businesses. It is very rare that a bad business manages to successfully price risk. Those two things just tend not to go together. And if it is a good business, it is likely going to attract mainstream capital, which means that an impact investor doesn't really get any particular advantage participating. They're just being part of an asset that is being bid up by the market. Now, in private markets, maybe you could say that the CEO or the founder or the person receiving the money might rather have an impact investor give them money than an average investor. This was incidentally true for us at Altruistic. But there you kind of have to have then a sort of a CEO or founder who is happy to actually not push for the highest price because they're happy to take a slight haircut. So in both situations, the value thesis of saying, well, can an impact investor do as well as the market doesn't really hold up, because the impact investor only does as well as the market when they make a market standard investment. And so I think that thesis tends to be structurally unsound. I think with impact investing in general, this is the sort of second learning, is that I think that there's an intellectual honesty problem, which is we believe that impact investing can balance this sort of double bottom line, with both elements of the double bottom line being equally important. We can serve God and mammon at the same time. We can make money and do societal good at the same time in equal measure. But empirically, you can't solve for a maximalist position on two variables without a trade-off to some degree between the two. If you think of mission alignment is a constraint. It means that there are certain things that you will not do for the sake purely of money, which means that your monetary results will just not be as good as your results if you were doing something purely for the money. And so I think that this sort of intellectual honesty problem is one of the original sins at the heart of impact investing. The third thing that we've learned, and this one is one that I've talked about on this show previously and many others have talked about, is the measurement problem of impact investing, which is it's never really been clear what is included, what should be included, what should not be included, and also how you measure success against the different elements. We tend to take things like S&P criteria or frameworks, emissions intensity measures, different sorts of metrics that we use to judge success. But actually, ESG is a mixed bag in itself. It's hard to say that the outcomes of an affordable housing project are comparable to the outcomes of a renewable energy project. They're very different categories. And so, I would actually say that it makes sense to me that there might be a thematic investment behind affordable housing, and it makes sense to me that there might be a thematic investment behind renewable energy, and it makes sense that investors investing in either of these themes might measure success within those themes between different assets. But comparing them across different themes just seems a little asinine, to take one of my CFO's favorite words. So with that, those are my sort of three big learnings from this. Now, what are the cases where I think impact investing can succeed? And I think there are a few, actually. I would say that there are, in my view, three areas where impact investing can have a viable future, but I think they require honesty and integrity in those managing the money. In particular, and also, I guess, in those putting forward the money. So both the LPs, the limited partners with the funds, and the GPs, the general partners managing the funds. The first, I would say, is around brand equity and strategic value. And I think this is most true for corporate venture capital, maybe large family office type private equity, where the impact label itself is a balance sheet asset of a type for the parent. And so in a corporate VC, for example, you could see how impact investing could serve a purpose with creating brand credentials, really boosting the company's brand. One example that I really like is, and I think this is like not actually happening in practice, this is just a fantasy of mine, but if you look at Coke Studio. This podcast is brought to you by Altruistic. Sustainability teams have one thing in common. They all have messy data sitting in silos across the business. This means 60% or more of their time is spent getting data into shape and not making sense of that data or using it to drive action. Altruistic's AI-based tools can help. Meet Evie, your in-house, always-on-call sustainability assistant. Evie works alongside you and your teams to clean up and transform your enterprise data into usable emissions calculations. Even better, Evie helps you interrogate this data, working like the junior analyst you wish you had. AI alone won't solve all your problems, but data transformation is one you can cross off your list. Visit altruistic.com to find out more. That's altruistic with a Q. Coke Studio is really well known in certain parts of the world, in places like Pakistan, I think in Brazil, in Turkey, in India, where it's really developed the local music scene. It's kind of been a platform where local musicians can come and become known. And Coke Studio has really been, I would say, a marketing asset for Coke in those areas. But you could see how Coke Studio could also be spun off and be an impact investment of a certain type because it is serving a social purpose of some sort. But at the same time, it is building brand equity for Coke. It's kind of a fairly independent business. It does independent things. The music appears on mainstream TV and is widely watched and listened and released. I don't know what their commercial model is, but you could well see them having a commercial model. But at the same time, it could also boost the brand credentials. I know that Danone has experimented with low-cost nutritional products in emerging markets like Bangladesh. You could see how an investment strategy that invested in similar third-party products, maybe at a lower cost, where actually Danone could bring some know-how and R&D to the table alongside money. You could see how that could really boost brand equity and brand perception, which would help with talent. It would help with building trust for their core products, boosting their sort of license to operate in emerging markets, for example. I think there's a lot of ways in which you could make the case for a corporate VC that took a sensible and brand-aligned approach to impact investment, which means that they tended to invest in things that were adjacent to their core competences and kind of in sync with their strategy. Other examples are Microsoft's Climate Innovation Fund, Amazon's Climate Pledge Fund. You could see these funds really, some might call them greenwashing, others might call them boosting trust, brand perception, talent attraction, etc. That's one category. Second category that I quite like is venture philanthropy, which I touched on a little earlier and I think still has a place and will continue to have a place. Many philanthropists that I know personally, and I say this not just from my experience at Altruistic, but also from having started nonprofits as well in the climate and environmental space, many philanthropists genuinely find that capitalism is a more effective way for them to do good with their money. Because their logic is, if I'm investing $1 in a nonprofit for philanthropic work, my dollar is typically going to be spent on operating expenditure. Every nonprofit actually is struggling to raise money for operating expenditure. They often don't have money they often don't want to necessarily raise for massive flagship projects. They want to raise to cover the cost of the person raising the money, to cover the cost of the office space, to cover the cost of, just the basic incidentals that they need, because typically no one is happy to cover those costs. These are a lot of the bread and butter of the sort of nonprofit model is just, I have these fixed costs that I need to cover to keep my entity going, and I need philanthropy to cover that. And so for a philanthropist, putting $1 behind that means that the dollar is worth a dollar and it's going to then disappear. If you're investing in a project, the project will take a haircut because there's going to be the headquarters tithe or share of that. And then there's the amount that goes towards the project. So as the nonprofit running the project, I'm going to take 20 cents on the dollar to cover my operational expenditures, see point above, pay the office, pay for all my costs. And then 80 cents might go towards the net project, which means that actually my dollar is at best a dollar and at worst it's 80 cents or 70 cents or 60 cents in terms of impact. Now, if you invest that same dollar, let's say in venture philanthropy, which means that you take, let's say, an affordable housing project that is there for profit, a renewable energy project that is there for profit, but is also doing a social good as you believe it or as you conceive it, then actually, if that project is going to deliver, let's say, a 10% annualized return, then actually your dollar could be $1.10 or $1.15 or $1.20, depending on how you calculate the compounding, which means that your dollar actually has an ongoing life. Just from a personal example, I gave a friend of mine a present a couple of years ago, which was I lent a certain amount of money. I forget which platform I use now. I actually got this idea from Baroness Worthington, who is one of the authors of the first climate legislation in the UK. And she said she'd done this with her husband, where she'd gifted him some debt, basically, that she'd given to emerging markets, social entrepreneurs. And so I did the same. And actually, a bunch of that debt has been repaid now and is ready to be redeployed somewhere else. And so in that way, my dollar, some of it has come back, which means that I can lend it back again, which means that actually my dollar gets a few cycles. So my dollar does a lot more good. And so venture philanthropy, both in terms of investment, but also in terms of lending, can be a really great way for philanthropists to get to double dip, triple dip, and just get more value for their philanthropy. Third example, catalytic first loss capital. I would say that this is a little more niche or a little more nuanced because it tends to be something which is true for development finance institutions or DFIs like the IFC, the World Bank, the Green Climate Fund, these sorts of organizations, where in an ideal world, they would participate in blended finance structures. A blended finance structure is where you say, I have a project. This project needs $100. If only any project needed $100. This project needs $1 million. And out of this $1 million, I know that I can generate a 5% return. Let's say I can generate $50,000 return on this $1 million, which is not a lot, actually. It's not enough for me to attract an investor given the risk profile of this. But what if I were to take that $1 million and I was to slice it up and get different types of investors to come in and take different slices there? So now maybe I say, actually, I will try and find someone who is happy to effectively donate $300,000. And so maybe there's a philanthropic side there, which I'm saying basically, I want you to donate $300,000. You're not going to get anything back, but this is competing with other places that you might donate money. Now, actually, I have $50,000 of return available for $700,000 of investment. Now, maybe I say, actually, for $400,000 of that, I can offer up 2% return. So I can give $400,000. I can give them $8,000. This is testing my quick fire math. $8,000 of return, which means that I'm still below par for what I can get from a mainstream investor, but maybe I can get an IFC or a World Bank to accept this below average return of 2%, because this allows me to then offer up the remaining $300,000 to a PE fund, for instance, at a $50,000 return, which is then around about, 17%. I hope my math is right on that. But roughly, basically, a good, attractive return for a mainstream investor on the bottom $300,000. And so you get this sort of tranching in this blended finance structure where you have different tranches. And often you could get a catalytic first loss capital coming in and taking that first $300,000 or the second tranche where it might be a debt component. And so in those areas, I think there's another place to play, particularly for multilaterals and development finance institutions. So just to kind of wrap things up, is impact investing dead or alive? I think that impact investing needs a serious rebrand and a serious downscale of expectation, actually. And I think that means that actually, if we're honest about it, we will expect to see more money flow out of the space because it doesn't make sense at the level that it is today. I think $1.5 trillion or thereabouts in impact capital seems like a story for mismanagement. And so I think that if we can be really focused about who should be investing in impact investment, which means either you want to go in for venture philanthropy, or actually you're not looking purely at the monetary return because there's a strategic or a brand value for your entity in doing this, or you're there as a multilateral, you have by nature a mission orientation to the funds that have been entrusted to you, and you want to be catalytic finance in a larger project or in a project where other investors are coming in. I think in these places it can make sense. I think we need to really solve the measurement problem, and I think we can do that by being very focused with the themes where this money is going. ESG as like a basket for many different themes all at the same time doesn't make any sense, and I think is a way for no one to get what they need from this investment. And I think then you want to have this expectation management or expectation alignment, where you know that as a result of your focus and your double variable, you're unlikely to get market competing returns. You don't pretend to get market competing returns, and therefore you don't consider it a failure when you don't get market competing returns. So with that, I actually think impact investing could be an exciting place for money to go, for money to be managed, and for professionals in the asset management space to focus their energy. I hope I haven't put anyone off the space with this episode, but if you feel like I've mischaracterized anything, please drop me a note and let me know, and I will be sure to touch on it in one of our subsequent episodes. That's it for this edition of The State of Sustainability. If you enjoyed the show, hit follow so you never miss an episode. And if you want to do us a favor, please consider sharing this episode with a friend. Anything you can do to promote the show is really appreciated.